everyone, welcome back to Deriv All Access. Last week, we saw Bitcoin surge to a new all-time high, past the 110K mark. And gold is back on the move with Moody's US downgrade. And all along, Japan is worrying about debt signals, and they're getting louder. I'm Yoli, the head of marketing at Deriv, and Prakash is joining me again. He's the head of product and growth to help us make sense of last week's market moves and learn what to expect for this week to come. All right, so let's talk about Bitcoin. A lot has happened since we last spoke, Prakash. Let's start with the talk of the town. It was the show stealer last week with a rally to a third all-time high in almost 6 months. Are we seeing a higher risk appetite? Or is it that Bitcoin is breaking out of the high risk asset area?
Thank you, Yoli. So it's crazy, right? 110,000. It's a very impressive move indeed. And, we've seen the narrative, the ETF flows, the renewed institutional participation. So no doubt this has been helping the spike higher. And this doesn't seem to be completely retail driven as it was in 2021, right? We're seeing volatility a lot lower. We're seeing funding levels very stable, and we're seeing a much bigger participation in Bitcoin versus other cryptos and altcoins. So whether it's escaped its speculative roots, I'm not sure yet. As mentioned,
but we're seeing institutions, we're seeing the ETFs. I mean, doesn't that mean that Bitcoin has become mainstream?
In a way, yes. So I think we have like 83% of institutions planning to increase exposure. And of course, plans yet aren't allocations. We're definitely seeing the strong flow into ETFs, and with ETFs, they aren't like the spot kind of Bitcoin, meaning it's more palatable for funds and for other players, like even corporate treasury desks, to be investing in ETFs. So definitely this has opened up the arena a lot more. However, you can still argue that the asset itself is high beta. There's going to be always a camp which argues it's not yet digital gold. Everyone's saying it's starting to behave like a macro asset, but I think the real test will come when we start seeing very sharp moves in other asset classes. Like, for example, if we see again a big sharp move in equities, or we see spikes in real yield, you'll be able to see what the correlation of Bitcoin looks like versus gold. So then you'll see whether this camp which is saying Bitcoin's is the new digital gold, we'll see whether that actually comes to fruition. So I think right now we're in a regime where liquidity is coming back, and we are seeing overall risk being rewarded. And in that environment, the Bitcoin narrative is doing well, but I don't think it yet means that it's shaken off its kind of speculative tag.
Yeah, I mean, we've also seen that the spikes, like the all-time highs, seem to be less spaced out than they used to be, whether in terms of value or time, unlike the situation from 2021 or 2023. Now the difference is only a couple of months or weeks, and the price difference is almost 2,000, less than 2%. So while the crazy spikes are always welcome by Bitcoin enthusiasts, would a lower volatility give Bitcoin a bigger share of traditional, traders' portfolios?
I completely agree. So the patterns have definitely been changing, right? When you look back at Bitcoin's bull runs, so we are seeing changing patterns. The climb now to all-time highs are a lot more measured in scope, and as mentioned already, the funding levels look stable. So evidence also suggests that it's less of a leveraged move, right? So with entry of institutions via these spot ETFs and trusts, we are seeing stronger hands coming into play. So I do think that the correlation and diversification benefits that Bitcoin offer are now being looked at closely by these players, right? So a key reason Bitcoin has gained some space in portfolios is its low correlation to other assets over the long run. So on a day-to-day basis, it might move with risk assets, but over the long horizon, it has lower correlation with stocks and bonds. So for portfolio construction, it's an interesting asset to have. And I think some studies have even shown that even a 1 to 5% allocation of Bitcoin in portfolios can increase your Sharpe ratio. So I do think that we are going to keep on seeing increased signs of adoption.
Yeah.
If we get regulatory clarity, that's going to provide more clarity around Bitcoin's regulatory status, and we will see more and more players being comfortable. Spot ETF was a huge step. And what to watch now is more players like banks offering Bitcoin custody, or governments starting to include Bitcoin in their plans as well. So all of this definitely will give Bitcoin a good ground, good foundation.
Lots to watch there. Okay, so let's talk about this downgrade. Moody's was the last of the rating agencies to downgrade the US credit rating. What does it mean? With long-term bond yields rising and deficit fears back in focus, is this a true fiscal turning point, or just deja vu with, a 2025 twist? Some people say that the agency ratings don't really apply to this, they don't apply the same pressure in the US as they do in the rest of the world. Is this true, or, at least for the markets?
This is a very interesting topic. And it's not the downgrade itself which changes things, right? So actually, we've seen other rating agencies downgrading the US in the past. For example, we had the S&P who downgraded the US in 2011, then Fitch followed in 2023, and now Moody's is the last of the three big agencies who've downgraded the US. So, but what's different now is the environment, right? So we're dealing with 36 trillion in federal debt. We have 30-year long bonds, 30-year yields holding above 5%, and interest costs for the US government nearing 1 trillion a year. So now this isn't about the pressure from the ratings, but it's about the markets starting to reflect the increasing fiscal risk. And what's interesting is that these repricings on their own don't cause crises. So it's very, very subtle here, right? Because some players in the market may argue, oh well, it's the US, a downgrade from right to AA1 doesn't mean a whole lot in the grand scheme of things. But when you start seeing these repricings happening, particularly in forex flows or in the yield curve, this is where you then start seeing hidden leverage that has been quietly building. So, for example, the longer that you have the long end yields stay elevated, the more likely we'll start seeing pressures emerge in rate sensitive sectors. So it reminds me of the days when I was on the US interest rate desk, right? This is around the time when the term bond vigilante was coined, and there was a small number of players who, at the time when the S&P downgraded the US, were all in on repricing of the long end, right? So, of course, that was a trade that was entered way too early, right? And it was again the same time where another phrase was coined, which was "Don't fight the Fed." So these were essentially a group of traders who were termed bond vigilantes, and they expected that the whole yield curve would reprice, and it didn't. Not to the extent which they expected. But this is kind of a very slow moving trade, and it reflects the complex system that we're in. For example, you can have a snow that keeps falling, but you just won't know when it's that final snowflake which causes the avalanche. So
what was it that Moody's saw, since they were the last ones, of the credit ratings? What is it that drove them to say, finally that we've got a downgrade? What is it that's happening that you think prompted them to do so?
yeah, so I think it's a variety of factors. I think you can um, probably get a copy of the report to explain it in Moody's own words, but what I take away are all of the fiscal red flags which they see. So, for example, $1 trillion deficits now being common even in years where we have no crisis. And of course, we have the climbing debt to GDP ratio, which has climbed above 120% now. So rising interest costs are compounding, right? So higher yields will mean more borrowing just to cover the interest. And I think the interest as a proportion of GDP, of course, is climbing as well. And I think it's around something like 3%, and it keeps climbing. So if you look at a chart of US federal debt as well, you just see it going just like this. And it really now, it used to take years to add $1 trillion to the US federal debt. Now it just takes months. And this is how rapidly this is how this is how the structurally this is how things are moving, and at some point in the future it may take just a few weeks to add that much debt, and this is not sustainable. So of course,
so is there a trade? Like how do traders take advantage of this?
Yes, this is interesting, because of course you see people who tried to put the trade on 13, 15 years ago. And that this is the thing, is this could be a very slow moving thing. And if we're thinking in terms of timeframes, the trade may not come about for another couple of years, right? But what we may see now is, as long as we keep seeing the long end yields remain elevated, right, we'll start seeing pressures building elsewhere, because we have a huge amount of debt which was issued at much lower coupons. So all of these positions will start, well, they're already deep underwater, but the more long in yields rise, the more losses that these players will have to take on the long end treasury. So we have banks and insurers holding these long duration bonds at very low coupons. We have pension funds, we have asset managers now who are going to be thinking about rebalancing, between stocks and bonds. And then we have like real estate, we have REITs, we have all of these other firms which are going to be pressured by the rising discount rates. So these pressures may keep building, and even though they keep building, we may not still see them come to surface for a while. And then if you talk about contagion, then we have other sovereigns which have weaker credit profiles as well, and they
So
could also.
how does this, sorry, Prakash, how does this tie into, I've been hearing people talk about the trade away from the US. Is it about diversification within your own within US assets, or should people potentially be thinking about, other markets?
I think people will be portfolio. So in terms of within the US, I think there's hedge funds and others who are positioning for more turmoil in the long end. So we could see, for example, long end yields push towards 5.5 and beyond. So there's some trades there. The also the higher long end yields could raise discount rates. That could put some pressure on high growth and tech stocks in the US. So there is that transmission mechanism, but maybe it's a little bit weak. It depends on cash flows. It depends on the ability of these companies to roll over debt, et cetera, et cetera. But once you have a scenario like this coupled with another exogenous shock, like a credit shock or something, and you see the spreads between corporates and the US yield curve widening, then you start seeing, a lot more contagion between the US and the corporate sector as well. So I think 30-year yields, right? If we start seeing them closer to 6%, this may start challenging some sectors, so the heavy debt sectors, right? And we do have a group of people who've said that the world never really recovered from the what do you call it?
Like the financial crisis?
Crisis, exactly. The GFC.
Yeah.
Thank you. The GFC never really recovered from that. All we did, right, is we just basically kicked the can down the road. And if you think the world, the developed world has enjoyed low interest rates for a very long time, and structurally, if you chart the 10-year yield over the last 100 years, you can see that the chart has been falling. 10-year yields have generally been falling. So the world loves low yields, right? So if yields start rising, then this will definitely be challenging for sectors which are debt heavy and up until now have been able to roll over debt. So I think this is a big story, and it can be a very big story if yields keep rising. I think there's going to be a lot of stress and pressure if this keeps on happening.
Yeah.
And banks may benefit initially, right? You have margin expansion, but I think there could be a larger slowdown, right?
That's why we're seeing like gold kind of creeping back up. Do you think that there's it's considered a safe haven? So is it stronger gold or weaker dollar? Like why? What are you thinking? We've been talking about gold for a couple of weeks.
Yes, I agree. I think this was one of the catalysts that gold needed to resume its upward trend. Otherwise, I think a lot of the technical factors, I think I mentioned it last week, were pointing that it would keep falling. So I think now we have a mix of these concerns, the fiscal red flags and the downgrade concerns. Plus, we do have, I think, an uptick in the geopolitical tensions as well. And in the background, we're still seeing that steady central bank buying. And it is, I think, a weaker dollar story as well. We're seeing the dollar index coming off its highs. So I think although gold has not managed to match Bitcoin's pace, right? I think I think we'll probably see a retest of the
Yeah.
high. Bitcoin, so gold is now back above 3,300. So I think from here, right, we could see now break above 3,400, and that could set up the path to retest this 3,500 highs that we had, I think a month or two ago. So I think there's some opportunities, short term and intermediate, there. The narrative, the long narrative, alongside narrative, still has a lot to play out.
Yeah.
I think these concerns are valid, right? The debt is in general is out of control, and in these situations, it's like it's a rush for the exit, and it's that exit. It's a very, very narrow exit. And when everyone rushes for the exit, then you start seeing a lot more volatility. So watching out for more volatility, watching out for certain indicators like the moving gold. I think
Yeah.
that's going to set the tone.
You mentioned global tensions. The oil markets are all over the place right now. We've got this perfect storm brewing, Middle East tensions pushing prices up while US stockpiles keep climbing. You know, OPEC is supposed to be meeting on the 1st of June, and everyone's wondering if they'll announce, output cuts. So what should oil traders be watching in these next few weeks?
The meeting on the 1st, I think, will be very important for the signal to the wider market. I think oil is caught between a lot of these noisy headlines and shifting fundamentals. So in oil, it's really the same narrative that I was speaking about last week. It's a lot of intraday swings, geopolitical shocks pushing it one way or the other. And right now, the oil market looks a little bit loose, right? So inventory data is soft. OPEC Plus may shift towards output increases, right? And if this is confirmed in later on in the week, that could be a structural change. So until then, I think that definitely the signals that people will be looking for are the stockpile trends, right? And I think here we do have like a tradable range, right? We've not really seen any kind of conviction breakout, and we
What
saw.
is that range? Like, what should traders be looking for? Are there any spots you can kind of point to?
Yeah, so the range in WTI with the support level, which I discussed last week, that's $60 support. And that seems to be the refill zone for the strategic petroleum reserve. And then I think resistance we're looking at around $75 to $80. That's been the historic ceiling at the moment.
Excellent. Well, you heard that, traders. We're looking at a range of 60 to 75. Let's talk about Japan. Japan's fiscal alarm bells are ringing. 40-year yields are hitting 20-year highs. And Prime Minister Ishiba is calling the outlook worse than Greece. I remember that time. And the Telegraph described it as the debt crisis threatening to blow up the global economy. Are we watching the next big bond crisis unfold, or is Japan's bond market reacting to US credit fears? Or is this just a Japan problem?
This is very interesting, right? I mean, Japan has had a debt to GDP ratio of more than 200%. I think 200, 250, 260% ever since I lived in Japan, like, almost 20 years ago. So, and since then, I mean, it's been the same kind of chatter. Is Japan the next Greece? Definitely not. If you think about
what makes you say that,
what we're seeing right now with the long end yields is we are seeing, yes, 30-year yields above 3%, 40 yields 3.6%. So yes, it's unheard of for a country which has long been anchored to zero rates, but it's just a meaningful repricing. So one thing which people always maybe forget about when we're talking about debt to GDP ratios or high debt to GDP ratios is that most of Japan's debt is held domestically. It's held by Japan's own banks and pension funds, etc. Right? So in that sense, there's no. So that's opposed to the US, right, where a lot of the US debt is held by foreign institutions, right? So the majority of Japan's debt is held domestically. So in that respect, there's no risk of like a capital flight, right? So there's not going to be like a loss of confidence by investors abroad, right? Because the debt's held domestically. But what we can see, right, if yields keep climbing, is we could see the pressure spread beyond Japan, but that would happen through the FX, the forex market, global flows, and investor psychology as well. So, for example, what we could see is sharp volatility in yen crosses, and that's something we already been seeing, right? So yen has been strengthening against the majors last week, and why is that? And that is because the expectation that a lot of these the companies who are holding capital abroad will start repatriating them back to Japan, right? So that would essentially cause more demand in Japanese yen, right? So, and why would they do that? Well, the narrative is that, well, all of these the companies may decide, hey, we would rather be buying JGB yields, right, at a yield of 30-year JGBs at a yield of 3.1, or 40 years at a yield of 3.6. So this is I think what the market's doing right now is it's pricing in what the expectation could be. Expectation, we could see a repatriation in flows. We could see the yen. So we could see currency volatility, which would strengthen the yen. We could see, for example, Japan also selling some of their holdings of US debt, right, to improve their fiscal situation.
Let me try and connect the dots, because you said, so the prime minister said it could be worse than Greece, and you said this, it's mostly the domestic banks, Last time, if I recall, in Greece, there was sort of a run on the banks, but you're saying we may see this repatriation. And so are you saying that the challenges are like isolated to Japan and wouldn't impact, the US, for example? Or could this end up impacting the global economy? What would need to happen for that to happen?
So if you're looking at the language that was used, worse than Greece,
Yeah.
To me, the situation, it's less about the default risk of Japan, right? It's more about the market signaling that their fiscal tolerance to Japan is nearing its limit. So if policy missteps follow, right, like fiscal easing into this bond weakness, that could accelerate the volatility. But this, we've been in this situation for a very long time, right? This is not new. Fair play. The pressure on long end yields, that's new. However, what is important is the next steps. So it's the global flows, it's the transmission in with the forex markets. So I guess the risk channels will be if the JGBs. So in a similar situation with the US, you could have Japanese banks having to face mark-to-market losses, right? We could have illiquidity in the long-end JGBs. We could have these global carry trades unwinding if the yen volatility spikes. So, for example, if the yen gets stronger versus the dollar, we could see a huge unwind in these in the global carry trades, and that will just accelerate the strengthening of the yen versus the dollar. So we had the dollar yen, for example, nearing 150 just I think a week or two ago, right? This was kind of the right after the Trump China rollback, but from that level, it's gone to under 143. If this narrative continues, we could see dollar yen falling below 140. So
what is the trade? If what happens, the yen will strengthen, and if what happens, the yen will drop.
If we see some stance from the government to improve their fiscal stance, then this is likely to ease the pressure on dollar yen.
Okay.
We could see dollar yen rise. However, we see silence from the government. We see we keep seeing pressures on the long end. We see talk of Japan selling their US treasuries increasing. We see weak JGB auction, right? We see all of these. We see evidence of repatriation pressure. Then we see the dollar yen continuing to fall, and in my opinion, it would go below 140. So in the down move, it accelerates very quickly. So these are pressures, in my opinion. Their dollar weakness can come from a number of transmission mechanisms. So I do like the stronger yen, weaker dollar narrative.
All right. Well, thank you so much, Prakash. I think you've given traders a lot to watch for in this coming week. And we'll be back in another week with a wrap up. If you are watching us on YouTube, please hit the subscribe button and turn your notifications on. If you're listening to us on one of your favorite podcasting platforms, please hit the subscribe button. Thank you for joining us, Prakash.
Thank you.